Over the last few videos, we've looked at how you extract profits. That's dividends, pensions, and timing. There's a bigger question many directors don't ask. And once serious profits are built up inside your company, is leaving that capital there actually the right long-term decision? Because cash sitting inside your trading company is not neutral. It's an asset class and it carries structural risk. Now, let me explain what I mean. When your company generates profit, corporation tax applies first, currently up to 25% for many profitable businesses. But after that, retained profits often remain inside the company. And that feels sensible, liquid, flexible, available. And now imagine a director with £800,000 of retained profits accumulated over time. If the majority of their net worth sits in one trading entity, in one sector, under one legal wrapper, that isn't diversification, it's concentration. The business might be strong, but structurally your personal wealth becomes dependent on the continued performance and eventual sale of one company. Same capital, different location, different risk profile. Now, most directors do not intentionally concentrate risk. They do it because familiarity bias keeps capital where it feels most comfortable. The company's known, you built it, you understand it. So leaving surplus cash inside feels prudent. But familiarity doesn't equal diversification, and over time, structural dependency can quietly increase. Cash inside a company is not doing nothing. It sits inside corporation tax rules, inside business risk exposure, inside future extraction tax decisions. So if your long-term objective is personal financial independence, not just business growth, there may be a mismatch between where the capital is stored or what it is meant to ultimately achieve. A trading company is designed to operate a business. It's not automatically designed to function as a long-term personal investment vehicle indefinitely. Now, that distinction really matters. Directors often focus on what to invest in, whether it's equities, property, pensions, cash reserves. But sophisticated planning often begins with a different question. Where should capital sit? On the company balance sheet, in personal ownership, inside a pension wrapper, in a holding structure? Because location determines the tax interaction, the access timing, risk exposure, and succession flexibility. This is wealth architecture, not just tax efficiency. Now consider this through an exit lens. If 70, 80, or even 90% of your wealth is tied directly or indirectly to your trading company, your future flexibility becomes dependent on a single event, a single sale. If that sale is delayed or revalued or structured differently than expected, then your financial independence timeline can also shift. Gradually repositioning capital over time can reduce that structural reliance. This isn't about avoiding tax, it's about reducing dependency on one entity. Now, in previous videos, we looked at dividends, pension contributions, and timing. This question of capital location sits alongside those decisions. It's part of the same wider series exploring how directors move money from company balance sheet to personal wealth more intelligently. In the next video, we'll explore concentration risk more directly. Because what happens when 80% of your wealth sits in one basket? If this kind of structured, director-focused planning is useful, you may want to subscribe. I'm Stephen Pitcher, and I'll see you in the next video.